This is Business Talk with Jim Campbell, nationally syndicated over the Biz Talk Radio Network, 350 stations around the country. And each year at this time, we have a show for my business hero, Warren Buffett, on the Berkshire Hathaway annual meeting. But this is the first time we've actually come to Omaha. And we are in the Hilton Omaha lobby, which is attached to the CenturyLink, where tomorrow 40,000 people descend on Omaha, which is pretty amazing in and of itself. And appropriately, we're starting off with a Berkshire subsidiary CEO of Oriental Trading Company with an incredibly impressive background. That's Sam Taylor, CEO of Oriental Trading Company, Inc., the nation's largest direct marketer of party supplies, arts and crafts, toys and novelties, and a leading direct marketer of school supplies as well. Recognized as one of the top 50 internet retailers, the company offers over 40,000 products. And prior to Oriental Trading, he was a senior VP of Consumer Direct at HP.com, at Hewlett-Packard, SVP Online Stores and Marketing at Best Buy, e-commerce at Land's End, Disney, and Bain Consulting. Wow, that's pretty impressive. Welcome, Sam. Good to have you here.
Thank you very much, Jim. It's great to be here.
All right, the first question has got to be, you're part of the Berkshire family, and all we hear about is how special that is. How special is it?
It's amazing. There's nothing like it. And I've been lucky in my career, as you mentioned. I've worked for a lot of large public companies. When I joined Oriental Trading in 2008, we were owned by private equity. We did a financial restructuring. We were owned by hedge funds. So I've seen it all. And I tell our employees every day, there is nothing like being owned by Berkshire Hathaway. We achieved the pinnacle of possible outcomes in our journey at Oriental Trading. And part of it is the culture is so special. So the Berkshire Hathaway culture, it really is. It's about two things. It's about integrity and autonomy. And we are so blessed to be part of one of the largest public companies in the world, but we're able to operate as owner-operators. We get to run the business as if it's our family business. We can be entrepreneurial. So we have all those resources at Berkshire Hathaway, but we get to be entrepreneurial. We have autonomy, and we're able to grow the business the way we want to.
Integrity and autonomy, it's a pretty good combination. I don't know if you know Jeff Matthews. He's a hedge fund owner, but he's the one who recommended I speak to you because you were part of a private equity holdings and as well have been a public company. Tell us the fundamental difference between Berkshire Hathaway, how he leaves you alone, quarterly focus issues, the stuff you deal with the public company, and then, of course, the private equity.
Yeah, the big difference, well, with public companies, obviously you're living quarter to quarter. I thought maybe that would change with private equity, but, when times are good in private equity, it's different. I joined in 2008, right before the Great Recession, so in tough times. And when time gets tough in private equity, it's week to week. It turns into a lot of micromanagement in challenging times, and that's what we were kind of going through. The huge difference with Warren Buffett is he thinks long term. I mean, when my first meeting with Warren, he said, I don't worry about this quarter, about this year. I'm focused on the next 5, 10, 15 years for Oriental Trading. And I've never seen anything like that. Any public company, any private equity experience, nobody thinks long term like Warren Buffett.
You hear that he customarily needs 5 minutes to make a decision on whether he thinks you're someone he wants to work with integrity-wise, culture-wise, and whether the business economics. Was that kind of true? How did he come to do the deal for you guys?
I think it's an amazing story. So, like I mentioned, we had been owned by private equity. We went through a financial restructuring. We came out with new owners, which were our previous senior debt holders, who weren't in the business to hold it long term. This was in early 2011 when we came out of our restructuring. The company, even through the restructuring, we were performing very well. The company's always been very profitable. And so after a little over a year, we were performing well, and our owners were deciding, well, maybe it's time to sell the business. We went through a sale process. They didn't get the valuations they were looking for, and that's when my CFO came to me and said, now we need to talk to Warren, because Warren, he doesn't get involved in auctions. And so we got approval from our board. We got our number from our board, and my CFO sent an email actually to Mark Hamburg, the CFO at Berkshire Hathaway, on a Friday around 10 o'clock in the morning, and within 2 hours the phone rang, and it was Warren Buffett calling up saying, tell me about the business. So I told him about the business. He said, send me over whatever financials you have. That was a Friday. He said, I'll get back to you soon. That next Tuesday, he called up and says, yeah, I'm around all week. We should meet. I said, we can be there in an hour because we're here in Omaha.
Yeah.
And he said, come on over. So my CFO and I, we went over, met with Warren and a couple of his key lieutenants, 2-hour meeting. And at the end of the 2 hours, he said, let's do it. Let's do this.
Wow. And you have the same feeling that this was a marriage made in heaven kind of thing?
I feel extremely fortunate that it worked. I tell our employees, out of the hundreds of possible outcomes, we achieved the pinnacle, the very best. I think it is. He had mentioned, he's had his eye on the company. In fact, he kind of joked. He said, I should have bought this company a long time ago. But for us, one of the other big changes is we have a permanent home. When you're owned by private equity, every 3, 5, 7 years, you're up for sale. You know that. And that's
and it's
really
forever
hard.
with Berkshire.
And he came out and talked to all of our employees. He says, I bought Oriental Trading, and I'm going to own it forever. And for all of our employees, for the management team, that's a huge relief, that sense of permanence, and we can build on that.
And it's real. Before we get back to Mr. Buffett, tell us a little bit of what Oriental Trading is about. 40,000 products seems hard for me to conceive of how you can manage it. Maybe your business model?
Yeah, well, and that's part of our moat. So, as when people ask me sometimes, what was it that Warren Buffett saw in Oriental Trading? And so he looks for three key things. He looks for, first, a management team, strong management team that he can trust. Secondly, he looks for a strong business model that generates a lot of cash, and we have that. We have double-digit operating margins, so a very profitable business. And third, he looks for that competitive moat. And part of that competitive moat for Oriental Trading is our product assortment. So we have over 40,000 products. Over half of those are proprietary products that we have developed. You can't find them anywhere else. We have our brand name, very strong brand. If you talk to our customer loyalty scores, Net Promoter Score, is over 70%. That's world-class. That's like Southwest Airlines, Harley-Davidson.
Wow.
So very strong brand equity. When our customers come to us, they're planning typically some kind of event. It could be a birthday party, graduation, wedding, a school event, company event, and they're looking for a whole solution. And that's what we provide, a one-stop shop. We pull the whole solution together, make it easy for them, and we help them save money. We have guaranteed lowest prices. Value is critical today.
Wow.
And our customer, that's what she's looking for. She's looking for somebody that can save her time and money, and that's where Oriental Trading comes in.
Very impressive. Now, tell us, you're inside the company now. What's your ongoing relationship with Buffett? How do you interact? How often? How hands-on is he?
Well, it's funny because in that first meeting I had with him, I said, how involved do you get? Do you get involved in strategy? And he laughed. He says, I don't get involved in operations and strategy. He said, I want you to run this like it's your family business. He said, the only time you need to come to me is if you want to do an acquisition, because obviously he's passionate about capital allocation. He's really good at it, obviously. And so we have done 2 acquisitions, and both times we had to run those by Warren and get his feedback, and he weighed in on that. But, my interactions are, he's known for being, autonomy is the culture, and he's very hands-off. Once a month I put together a board letter. And the chairman of Oriental Trading is actually Tracy Britt Cool. So she's one of Warren's.
Yes, okay, I know that.
So Tracy is our chairman. So I write every month. I write a letter, CEO letter to the board. It goes to Tracy, goes to Warren. Has our financials for the month. Talks about what we're doing in all the different parts of our business. And I know he reads them because every now and then I'll get a handwritten note from Warren, and there's no better feeling than that. For CEO, a handwritten note on a piece of his stationery, and it'll say, great quarter.
Blew it out, yeah.
Yeah, he's amazing. You guys are doing great work. He says, you're making me look good, Warren. And so he's reading those, but the interactions are not a lot. Every now and then we've reached out to him for some help. We had our wholesale business wanted some help selling a big account, and we put together a fun music video. And Warren, I said, would you do a cameo? He said, sure. And so we went over and filmed, and he was a cameo in our music video. So he's there if we need him, but he's very hands-off.
How's it working through Tracy Britt Cool? Because I know she's rather new.
Yep. It's working great. And so, Tracy, when we do meet, it's typically with Tracy. It could be every 3 or 4 months or so. She's got more responsibility now because she's now actually CEO of Pampered Chef as well. Oh. So she's got that role as well. But it's good because if there are certain things that I need to bring, and I can get responses quickly, I'll run them by Tracy. She'll run them by Warren. But it's been working very well. She's got a couple other portfolio companies that she is chairman of. And I know Warren at one point mentioned that helped him make the decision to buy Oriental Trading. He's like, there's 80 portfolio companies. He's got a lot on his plate. And I think being able to have Tracy and have her oversee some of these companies made it an easier decision for him in 2012 when he decided to acquire Oriental Trading. And Tracy was in that initial meeting along with Ted and Todd. I think that made it easier for him to make the decision. Okay, because we're smaller than his typical acquisition, but we're a substantial business. We're by far not the smallest of the portfolio companies, but working with Tracy has been great.
Let me ask this. He said, I look out 1-5 years, but he notoriously thinks strategic plans, just create acquisitions that aren't needed. What kind of strategic planning do you do?
Well, we do, as a management team, myself and my executive team, In fact, on Monday, we're starting another offsite to talk about long-term strategic planning. So at least twice a year, my executive team, we get together and talk about the next 5 years for Oriental Trading. What does that look like? And actually, we're getting together since everybody's in town for the Berkshire weekend, because we've made a couple acquisitions, and so we have people from Smile Makers. They're based in South Carolina, one of our acquisitions, and then Mindware's up in Minnesota, but they're here for the weekend. So then Monday and Tuesday, our executive team is getting together to talk about what do we got planned for the next 5 years for Oriental Trading.
Very impressive. We're talking with Sam Taylor, CEO of Berkshire subsidiary Oriental Trading Company, Inc., and we will be right back.
The ideal business is one that takes no capital, but yet grows. And there are a few businesses like that, and we own some. We'd love to find one that we could buy for 10 or 20 or $30 billion that was not capital intensive. And we may, but it's harder, and that does hurt us in terms of compounding earnings growth. Because obviously if you have a business that grows and gives you a lot of money every year and doesn't take it, it isn't required in its growth, you get a double-barreled effect from the earnings growth that occurs internally without the use of capital, and then you get the capital it produces to go and buy other businesses.
And we're back with Sam Taylor here on our opening interview, actually, in the lobby of the Hilton Omaha for the always famous Berkshire Hathaway, where 40,000 folks trek to what he calls the Woodstock of capitalism. You talked about autonomy. What's the level of involvement with other Berkshire subsidiaries? And is it mainly over this weekend?
Well, and it's interesting, and that's another difference between Berkshire Hathaway and I think, private equity. Typically, private equity companies, they have a portfolio of companies, and they encourage you to work together. Sometimes they almost force you to work together. And I asked Warren about that in that first meeting. He says, I let the companies decide. Yep. It is complete autonomy, but that's one of the beauties of Berkshire Weekend. For the last 4 years now, Berkshire Hathaway and Tracy Britt-Cool has been heading this up, is what we call the CEO Roundtable. So it started yesterday afternoon, where all the CEOs are invited, and I think there's at least 70 out of the 80 of us that came and had started meetings yesterday. And it's a great networking opportunity. And I was there with a lot of my especially the retail CEOs, and we were trading stories in terms of, best practices, what are we seeing in the marketplace, how are our businesses doing. And it's great because you can talk to some of the shoe folks that are, Brooks Running Shoes and Brown. I was talking with some of the jewelry folks, with Helzberg Diamond and with Borsheim, where's the furniture mart, and different segments with See's Candy. So you're getting a flavor of what's going on in different areas. And then we do work together. In fact, the CEO of Helzberg Diamond, she came out to Oriental Trading offices yesterday. She brought 5 people with her. They met with my team. She brought her some of her marketing folks, e-commerce operations. They sat down with our folks from Oriental Trading to share best practices and see, are there opportunities for us to work together? It's Helzberg Diamonds. We have a wedding business. Is there an opportunity for us to do some co-marketing and just some brainstorming? So we do work together where it makes sense. The Brooks Running Shoes folks, I've been working with Jim Weber and his team. They obviously are sponsoring a lot of races around the country. We have a spirit line of products at Oriental Trading for fundraising and spirit, and great with races. And so they've aligned us up with some of the race directors around the country. So there's obviously synergy opportunities, and
it's up to you guys to leverage them.
And it's up to, Warren leaves it up to us, to the CEOs, and that's why it's great having this event where we can spend a day and a half together and look for opportunities to work together.
In fact, I was going to ask you that question earlier. You talked about how nice it is to get a personal note. Most of the time when these portfolio companies are bought, the owners have more than enough money to be able to hang it up and go hunting or play golf or whatever. What keeps all you guys motivated?
Our love for the company. As you mentioned before, I've worked for a lot of really great companies, really great brands. But this is far and away the best experience I've ever had working for a company.
Are you guys selling stuff at the exhibition hall this weekend?
Absolutely. So we have our booth. Every year, our number one seller, we do a version, Warren and Charlie Rubber Ducky pair. This year, the theme for the conference is Berkshire by the Numbers, and we thought we would incorporate as many Berkshire portfolio companies as possible in our Rubber Duckies. So with Warren, we have, besides the Oriental Trading, our Flamingo, we've got, he's got the Dairy Queen ice cream cone, Benjamin Moore paints, he's got Justin Boots, we've got the Omaha World Herald. Charlie has some Pampered Chef utensils, the Geico Gecko, See's Candy. There's a diamond there, that could be...
So this is Buffett here? And
No, that's Charlie, and this is Warren. You can tell a little bit, the eyebrows, I think, are the key. So
Aflac looks like the Aflac duck. Maybe you guys are going to buy Aflac next.
We have, I think, over 200 different types of rubber duckies that we sell. They're always a big seller. This is our number one seller always. It's become a collectible. Every year it's a different version. It's always a lot of fun, but we have other products as well at the booth. We have a couple, Mindware, the educational toy and game company that we acquired.
Okay.
Their number one selling game is Quirkle, over 3 million sold, and we've developed a Berkshire Hathaway edition of Quirkle. And this year, another new product they have, it's a Warren Buffett porcelain bank that you can paint yourself. It's a DIY porcelain bank of Warren Buffett, encouraging kids to start saving early, to start investing
compounding.
Early. There you go.
You said you sell 90% of your products over the Internet. How are you leading in the Internet and mobility sales?
Yeah, we've really made a transition to being a digital retailer. So we transitioned from catalog retailing to multi-channel with really digital driving our business. So currently, year to date, almost 90% of our orders are coming through our website, through online, and about 83% of our sales are coming through digital. Obviously, our website is key, but where we're really seeing explosive growth is in mobile and specifically smartphone. So if we look this year to date, our smartphone traffic is up 33% to the website, and smartphone sales are up 53%.
Wow.
The reason the sales are growing faster is we've improved our conversion rate. You know, for any retailer right now, that's the big challenge is this explosive growth of smartphone. Every retailer is seeing it. But smartphone for retailing converts a lot lower than desktop.
From click to sale?
So if you look at conversion rate, a visitor comes to your site, and then what percentage buy, that's your conversion rate. On desktop, it's the highest, not a surprise. Tablet is a little bit lower, and then smartphone. And typically, tablet converts at maybe 2/3 of what a desktop would, and smartphone converts at maybe 1/3. We've made a lot of investments in digital, and we continue this year. But on the mobile front, we've made significant strides. Our conversion rates are 2 to 2.5 times that of the industry. Industry conversion rates are low, 1.2, 1.5%. We're significantly higher because of the enhancements we've made to our mobile experience. So it's really helping drive our growth, and we continue to focus on improving that digital experience for our customers.
Jody told me that you were on the CBS show Undercover Boss.
Yes.
How was that?
That was an amazing experience. So it was filmed in August of 2011, and then it aired in March of 2012. So it aired before we were acquired by Berkshire Hathaway.
Oh, okay.
For me, it was a once-in-a-lifetime experience to be able to work side by side with our employees. And the 4 jobs I did were all in our warehouse. We have a world-class warehouse.
In Omaha?
In Omaha, yep, in La Vista, which is one of the suburbs here in Omaha. And the reason I wanted to do the show is, as I looked at, employee engagement is really important for me. My philosophy is we take care of our employees, we let our employees take care of our customers, we let our customers spread the word, and everything else takes care of itself. When I joined the company, we used Gallup for our employee engagement survey. When I joined the company in 2008, our engagement was in the bottom 6%.
Really?
Bottom 6% of Gallup companies. And
wow.
I said, I've never seen an engagement this low. This is unacceptable. And so we've been working on that. Going Undercover Boss, I got to work in the area where we have our most employees. Almost half our employees are in the warehouse. It was one of our lower engagement areas. And I got to work side by side, rolling up my sleeve, getting to know these employees. If you watch the show, it's a unique experience. I was not recognized. I was concerned because they see me every 3 months because I go and talk to all of our employees.
You were not recognized.
But it was a great disguise, and I really got to see what it was like.
You got to see where the disconnects were?
Yeah, and the biggest lesson learned for me was communication. And I thought we were doing a good job communicating. I thought I was doing a good job communicating to our employees, and I realized it wasn't enough, and what was missing was the two-way communication. They had lots of great ideas that were not bubbling up. They were telling their supervisor, but then it wasn't happening, and the worst was there was no feedback loop. And sometimes they had good ideas and we were taking action on it, but they didn't even know because we weren't getting back to them. And that was one of the first changes I made after the show aired. My next meeting in the warehouse, I got in front of all those employees and I shared with them, over the last 3 months, here's all the things we've implemented based on your suggestions. And it's amazing the mindset that changed. And that was in 2012. Every year, our engagement has improved, and I was really pleased that last year, for the first time ever, we cracked into the top quartile for Gallup companies in terms of employee engagement. We were at 77th percentile.
Wow.
It took 7 years to get
6%.
there. It took 7 years, and that's one of the things I also realized. The hardest thing to change is company culture. It's the most challenging to change, but we're getting there, and we're finally in the top quartile. That's where the best-performing companies are in that top quartile for employee engagement.
And it's funny, under this economic environment, employee engagement is often the first thing that's sort of sacrificed when cuts have to be made all the time. And we're going to end up then on the question of your 2015 performance, which I understand was pretty impressive. You just went through the engagement part. Sum up how you guys did in 2015.
Yeah, 2015 was a record year for OTC, for Oriental Trading. So we had record high employee engagement, record high customer satisfaction, and it was our most profitable year in the last 9 years. And that's why I say it starts with employees taking care of customers, and then everything else takes care of itself. And we saw that.
That 6% starting point in improvement in engagement, did the customer service tracking results follow that exactly, or maybe lagged a little bit?
Well, it takes a while, but every year we've seen improvements in customer satisfaction.
Well, this has been a great way to kick off the Berkshire Hathaway annual meeting. You can see why these companies are so successful with the autonomy, with the integrity, with the quality of the CEOs, a tremendous background. And a happy CEO, but probably leads to happy employees. Sam Taylor, thanks for joining us.
Thank you very much, Jim.
And we're now honored to be joined on the phone by Jeff Matthews. He manages the hedge fund Ram Partners, a value-oriented hedge fund, and a nationally known expert on Mr. Buffett. Calls it like it is. He's got a distinctive financial blog. Jeff Matthews is not making this up. And he's the author of Secrets in Plain Sight, The Business and Investing Secrets of Warren Buffett, Pilgrimage to Warren Buffett's Omaha, a hedge fund manager's dispatches from inside the Berkshire Hathaway annual meeting, pretty appropriate for this weekend. And his most recent book, we had him on the show for this one as well, Warren Buffett's Successor, Who It Is and Why It Matters. Also, I want to say he's a great friend of the show and probably responsible for why we're sitting here in the Hilton Omaha lobby. It was his suggestion, and we pulled it off. So thank you, Jeff.
Hey, you're welcome anytime.
Now that I was just nice to you, I got to go on the other side. We're here for the first time ever. You've been coming, you can tell us the exact number of years, something like 30 years. You're not here for the first time. Is there any correlation there?
No correlation between my absence and your presence. It just so happens that I sold my stock in Berkshire last summer and don't get tickets anymore.
That's normally considered heresy. Tell us how long you owned it for and what made you make this kind of a major decision.
To correct your 30-year comment, I actually have only been coming for about a decade.
Oh, okay.
I have followed Buffett for my whole career, 35 years. I got to know his track record very early on and was very interested in his style and his technique. It goes back to my days as an oil analyst on Wall Street in 1980 when Buffett was buying General Foods during the oil crisis of the late 70s, and everybody else was running around buying oil stocks. And that's when I first really understood the genius of the guy, and so I've been following him ever since. And I took the opportunity during the financial crisis to buy his stock. So I'd owned it for about 10 years. And what bothered me was kind of a style drift, I guess, at Berkshire. He started buying companies for big prices rather than cheap prices. And the purchase of Precision Cast Parts last summer for $37 billion, kind of at the top of the market and a very rich price for a cyclical business, I just didn't understand what the margin of safety with Berkshire was anymore, so I sold my stock.
Was it a tough decision, and was it also size-related in any way that the secular growth rate just off of a large base obviously has to decelerate over time and has?
That never really bothered me. You understood that as Berkshire grew to the size that it was basically going to be a GDP plus a little bit type grower. It was no longer what I call your father's Berkshire back in the day when Buffett ran basically a hedge fund and took advantage of low stock prices and made terrific stock picks. It was a business of buying big companies with big cash flows that he generated, and as he kept getting bigger, the growth rates would get smaller. But what really bothered me was paying control premiums, which he'd never done before. When he bought the railroad in 2010, he stole it because he was buying it coming out of a financial crisis, and I thought that was brilliant. But the 2 or 3 deals prior to Precision Cast Parts also struck me as nothing too special, and then Precision Cast Parts was the icing on the cake. I just thought $37 billion for a cyclical business supplying airlines, which he hates, by the way. You know, he hates the airline business, but now you have a large supplier to them. I kind of thought it was madness. So the decision was actually very easy. It was, okay.
Do you attribute any particular reason for this? Does he have too much cash chasing stuff?
I think he is getting the company ready for post-Buffett. I think he wants to have lieutenants in place who can invest large chunks of Berkshire's capital for a very long period of time. So he's probably making a decent decision in the 50-year scheme of things. But when it comes to, is this a great investment to own a company that buys other companies for fancy prices? No, I don't think it is.
All right, let me ask you, we talked about those brilliant stock picks that he was known for. Some of the big holdings in his concentrated portfolio have real structural business model problems, and IBM, Coke, Walmart, P&G. He vowed for his entire career, you talk about style drift, not to get into technology. Do you have a sense of why he's in IBM, and is there something we're missing?
Well, I know exactly why he's in IBM because a friend of mine was visiting him on one of these presentations where he brings in graduate students and talks to them. And I said to this friend of mine a few years ago, I said, ask him why he bought IBM. What was the real trigger? Because he's known IBM for 50 years, right? I mean, he reads every annual report of every New York Stock Exchange company that he's interested in. He knows them forwards and backwards, and he bonded with Bill Gates 20-plus years ago over IBM. That was the first thing they talked about. You know, it was a famous story that neither of them really wanted to get together with each other, but it was Gates' mother wanted Gates to meet Warren Buffett, so they got together, and they started talking about IBM because Buffett knew the numbers and Gates knew the business. And so he's known the company, he knows the problems, he knows the financials as well as anybody. Why after 50 years did he decide to buy IBM? The answer was, and Buffett subsequently told this story on CNBC, so I'm not saying anything out of school. He said, I talked to our business guys, the guys who run our companies, and they say IBM, once you have IBM, it's really hard to get rid of. And he used the unpolitically correct joke of it's like AIDS. When you have AIDS, you can't get rid of it. When you have IBM, you can't get rid of it. And he thought that was great. And the pattern recognition in his mind is American Express. He's invested in American Express twice. And the second time he went back to it, the first time was during the salad oil scandal when it was, it was left for dead, and that was fabulous. He came back to it years later because a friend of his in the advertising business told him, you can't get rid of American Express. You have to use it. It's just locked in. Anybody who travels, any kind of business runs on American Express. So to him, he knew the numbers. He knew that IBM generated enormous cash flows. I don't know to the extent he realized how much the customers of IBM hated that. And I don't think he realized how underneath it all there was a developing cloud-based industry that was geared for just getting rid of IBM. And, when he heard that story about you can't get rid of IBM, he thought it was great because he knew the numbers and he knew the cash flow, and he figured, okay, I'm buying a cash machine. And that's when he went into it.
I'm bothered by the fact that I know it. Not only is IBM, had major problems, but they have a very disengaged workforce because they have done nothing but basically cut almost since 1990 as they change the mix of their business. Does that matter?
Sure it matters because the business itself is so dependent on guys going out in the field, having great relationships with their customers, solving problems, and then being able to sell IBM solutions for those problems. And if the workforce isn't happy and the workforce doesn't really believe in their mission, the way the guys at Amazon believe in their mission or the guys at Microsoft under their new CEO believe in their mission, that's a real problem, a huge problem.
Fascinating. You've sold Buffett. Do you see some next generation Berkshires out there?
Well, the one that looks like Berkshire and acts like Berkshire is Markel, our friends in Virginia. Tom Gaynor there thinks like Buffett, acts like Buffett, is buying businesses like Buffett. So that's, I think, a mini Berkshire. I don't know if it can replace Berkshire in the hearts and minds of all investors, but it's a pretty good Berkshire-like operator.
That was a good plug because we have Tom Gaynor on this afternoon.
Great guy.
We're going to finish up now, Jeff. Can you put your visionary cap on, and what do you describe Berkshire 20 years from now?
I will go out on a big limb and say that it's not going to look anything like it looks now because my guess is that once Buffett is gone, there will be a period of time where Berkshire will continue to move ahead as it has. But then once the guiding force dies down, there will be a lot of pressures to recognize value. And that will involve deconstructing a lot of what Buffett has built. So I actually think it will shrink.
Will that be a good thing?
Don't know.
Would you recommend hanging on to stock?
You have to use your own judgment. Look at Berkshire, evaluate it for what it is. I came to a conclusion that it no longer made sense to own something that was buying other companies for big premiums. That's not the model I bought for. I bought based on the idea that he was able to buy companies like Iscar and Benjamin Moore because they were privately held companies that wanted to sell only to Berkshire, and they were selling it to him at a good price and could provide enormous value to Berkshire shareholders over the year, and that he would use crises like 2008, 9, 10 to buy things like the railroad and make great investments, and that's kind of gone, and now he's paying big control premiums for companies like Precision Castparts. So I think it's a different animal, and you just have to use your own head.
We're talking with hedge fund manager and Buffett expert Jeff Matthews. I always love talking to you. And, of course, this show, which we do every year, wouldn't be this show without the fact that you've been on it every year. Carol Loomis has been on it every year after you started. So it's been a great interview. Thanks again for all the insights of getting us into this lobby. We'll miss you here, but love talking to you.
Thanks. Enjoy it immensely. As always, have a great time, and say hi to everybody you meet.
We have one surprise guest. My youngest great-grandchild, who will be about 7 months old, is also here today. If he happens to break out crying a lot, don't let it bother you. It's just his mother's explaining to him my views on inherited wealth.
And now we're honored to be joined by Rob Sullivan, who's here with his wife Celia, too. They're in from Massachusetts, actually. And I had asked Warren Buffett's assistant a while back if they might have a long-term investor. He came very highly recommended. She came right back with him. He is one of the lucky guys who actually had an A share, and I looked at the price this morning. It's right now trading at $217,630. And Rob Sullivan joins us now to tell us his story. I thought I had a great story that I bought a share at $15,000, but you beat me by a little bit.
Yeah, I bought basically my first shares through Blue Chip Stamps, because when we looked at the balance sheets, Blue Chip was carrying the investments at cost, and the insurance company, which was Berkshire, in that group was carrying them at market. So you got a lot more bang for your buck by buying Blue Chip Stamps at the time. Sometimes a 20%.
You arbitrage Buffett.
Why not?
That's a great story. Yeah. Now, I guess maybe do 2 minutes on what blue stamps are, because most people don't know.
Well, Blue Chip was...
Blue Chip Stamps, yeah.
One of the divisions a long time ago. They owned a big chunk of Wesco. They also had See's Candy. So if you looked at the operating businesses, they had by far the best operating businesses with basically almost the same portfolio as Berkshire. To my feeling, when we did the intrinsic value analysis, it was like a 50% up buying Blue Chip versus Berkshire at the time.
So you could essentially trade up the Blue Chip for Berkshire stock.
Blue Chip was bought out by Berkshire.
By Berkshire, okay.
In 83, I think it was.
Blue Chip Stamps was also a float business originally,
huge
right?
Float business.
And then, but
some of those stamps are still out there.
Is that right?
Oh, definitely.
Oh, yeah. So he's still got. That's
he's
awesome.
Still got a balance sheet somewhere with I owe somebody some money on some of these stamps.
Why did the business go belly up then, or why did it just die?
Like every trading stamp businesses, there were much more perks and everything else. Like now with charge cards, you can get 5% back on charge cards. Well, who's going to collect stamps to get a tennis racket for $120? I mean, they're not going to do it.
It's a license to steal money, because I still remember my mother cutting those things out, putting them in things in a drawer. Yes, S&H, and then never doing anything with it.
Of course not.
So you were ahead of the game, obviously. You probably taught Warren Float.
No.
So your cost ends up at what? What are you willing to reveal of that?
Well, I'll tell you a little bit. If you take a look at the first shares, we're probably around $100 for an A share, which is not a bad buy.
I need some oxygen.
It's not a bad buy.
That's probably one of the great investments.
And Wesco, we were way below that. We were around $2 and $3 and $4 a share on Wesco.
Do you still have Wesco shares?
No, it was bought out by Berkshire. Same thing.
Oh, it's bought out 100%.
Okay. In also.
I thought Charlie had some piece of it or something.
He doesn't even have the meetings anymore, which I used to love to go to.
Oh, those were just
Oh, those are great. There was like 12 of us.
Exactly, and he's just as brilliant as
you go
Warren.
3 hours.
Really?
It was
whatever
great.
You wanted to ask.
Phenomenal.
Did you get a bunch of shares?
Yeah, I got a bunch.
You got a bunch of shares.
Not enough, but of the first 400 A shares I bought, we have probably given away almost 370 of the A shares over the years.
Of the 400?
Of the first 400, yeah. But every year I gifted some to different institutions.
Is that right?
Springfield College, I'm on the board. They have some A shares. The Library and Museum's got some A shares. If you take a look at the Sisters of Providence, 10% of their portfolio at the Sisters of Providence in the Springfield area.
So you're a highly generous guy as well.
Oh, I douldn't give them all to them. They actually bought some.
I hope you kept some.
I have a few.
What is your job, your business, or what did you do?
Family business. Where I first learned about Warren was in '69 when I was reading Graham and Dodd. I was running a dorm at St. Bonaventure, and I read every book I could, and most of it was junk. Like he said, you get the blinders taken off, and I read Intrinsic Business with Graham and Dodd, all about intrinsic value and how to buy a dollar for a nickel. And it just made sense to me.
And it just, your psyche was attached to it,
absolutely.
Even while you were in college.
Absolutely. I didn't have any money, but, it was good I didn't have any money because 73, 4, and 5 came along and wiped out all these stocks, including Warren stock went down. So when I actually had some money in 75, 74,
you got a good deal on it.
I got a much better deal. So the timing worked to my benefit.
So how has Warren evolved over the years? Himself, his hold the meter, or how he's run these?
He's fundamentally, I think, a teacher.
Yes.
And I've got his first letters from the first letters to really his partners at the time, and there weren't many of them. And there were nothing as far as educational or...
They were not.
They were nothing. I mean, they just didn't have the information he has now. There might have been 8 pages, and most of it was mathematical. He talked about a little bit about, his balance sheet and that. But he wouldn't talk about his investments just like now. But he wouldn't have the humor. He wouldn't have the anecdotes. Yeah. He wouldn't be teaching. He evolved into a great teacher over the years.
It's fascinating. I almost view that he views himself as a teacher.
He is.
That this is a platform that he's got.
Yeah. My son just came out with Holy Cross College. He was a graduate in 08. And because they don't have a business school, they were always disallowed. So my son Bobby came out and he talked to Debbie, and Debbie talked to Warren. And they actually came out a couple years ago, even though they didn't have a business school. I call it the Bobby Sullivan exception. He was able, even though he had graduated, to come out with them and spend the weekend out here with the group from Holy Cross. And it was the first time ever a school other than a business school was allowed. And it's been a home run for the college.
He brings business schools.
Right.
Okay.
And it's a home run for the college. And if they came again, they'd have 800 people lined up to try to come out.
Have you gotten a chance to meet some of the legendary subsidiary folks like Mrs. B? Mrs.
Yeah.
So tell us about what you know.
Mrs. B, we bought a lot of furniture from her.
Did you?
She'd drive around in a little golf cart, and, she's probably in her 90s.
Right. Still working full-time.
Oh, unbelievable work ethic. And she would give Seal discounts on things that I didn't know how she got them, but really? She just like everyone, she loved my wife. And we bought 2 truckloads of furniture to bring into New England.
So you get some good deals.
Excellent deals. She was a nice person. Tom Murphy, we got the chance to meet
another
Murph.
guy that to me is like a hero.
Home run.
What was he like?
Very humble, and on top of it, he was a guy that had no airs about him. He would talk to everybody, and he was probably one of the most brilliant business person that we ever had a chance to meet.
The generosity that you obviously have, does that come from Buffett's philosophy of giving away, or is that just something that...
I think it was compounded. I think we started with that because we've had a scholarship fund in our local area for a number of years, and we've given away a couple $1 million worth of scholarships. Some people think that maybe I should have held on to those shares. I look at what Warren did, and that's a different approach, and I think he's a genius for doing it. But even now, he's given away more. We just felt that the need was greater than me having an extra automobile in the garage. And I still drive a pickup truck, and I still drive, an old Chevy, just like he used to do.
I was going to say, you're just as humble as all the folks you've been talking about, whether it's Tom Murphy, Charlie, or Warren, and now you're sharing it with everybody.
Right.
Obviously, a lifetime of good works. I was looking forward to meeting you very much. As I said, I asked Debbie if they could recommend somebody. It's a real honor. I thought 15,000 was pretty good. You beat me by a lot.
Well, every now and then, different people get the religion at different points in their life.
Different points in life.
And I say to everybody, including kids, start now.
Start now. All right, that's Rob Sullivan, longtime Berkshire shareholder, joining us. Thanks for your time.
Pleasure.
I did decide fairly early in life that my favorite employer was myself, and I've managed to avoid really aggravation of almost any sort. Really, if you or those around you that you love have health problems or something, I mean, that is a real tragedy, and there's not much you can do about it except it. But Charlie and I have really been blessed. I mean, here Charlie is 92, 85, and he's doing every day something that he finds fascinating. I think he probably finds what he is doing at 92 as interesting, as fascinating, as rewarding, as socially productive, as any period you could pick in his life.
And now we are moving to the international component. 40,000 people coming to the Omaha Berkshire Hathaway meeting. And we have a first chance to interview some folks from out of the country. And in fact, they are from Singapore. We've got Ivan Lowe. He's the author of Profit from Stock Tips and Profit from Mistakes, Chief Master Trainer for the Value Investing College, which we'll find out what that is. And he's been a stockbroker. Paul Chen, the head of research for the Value Investing College, leads a group of 30 researchers around Asia hunting for the best investment opportunities. Tell us first off, how did you get interested in Buffett? And just looking around the lobby here, there's a lot of folks here from the Far East. So is Buffett taking the Far East by storm? Go ahead, Paul.
Well, I guess value investing is not that well known in the Far East, but there is a small, but I guess very important community that has been forming and is becoming larger in the for the number of years. So value investing is catching up. I wouldn't say that it's trending, but it's definitely getting more attention now in the Far East.
Ivan, what is it about Buffett that's been able to pique people's interest and start to build?
Well, I would say that for Buffett in Singapore,
Yes.
probably in Far East itself, right? People actually acknowledge him as the guru of investing, especially in this value investing itself. And because of his results that he's given and that he's achieving, and a lot of people actually wanted to be kind of like Buffett himself. Yeah.
How long does it take you to get from Singapore to Omaha?
Oh, it's a long flight. At first, it's supposed to be 24 hours, but then we got caught in the tornado and we have to divert to SOX 4, and that adds another 3 hours, so that's 27 in all.
So wait, you went from Singapore to where to where? Where were stops?
Singapore to Narita, Tokyo, and then Minneapolis, and then to Omaha, but then we got diverted to SOX 4 and back to Omaha.
Yeah.
That's fun.
So and are you leaving Monday?
We're heading to Los Angeles where we have another event.
Oh, you have another event.
Yeah,
tomorrow.
but yeah.
Oh, I might add, that's with Mary Buffett, right?
Yes, that's right.
That's right.
Yeah, tell us how you work with her, because I've had her on my show and she's great.
Right. For Mary, actually, I met her in 2013 as well in Los Angeles. I came here for the AGM. And then how we work with her is that she's like a mentor to us. And she actually guided us along in terms of our program, as well as sharing in Singapore. Yeah.
We should mention that Mary Buffett was married to Warren Buffett's son, Peter.
Yeah.
All right. Well, the research guy, what is Value Investing College?
Well, Value Investing College is, teaching value investing, but we try to simplify things. So basically, we look for a good business, and we try to buy it at a undervalued price. So this is basically the essence of what we're trying to teach there. Yeah.
Are you building a portfolio then of stocks? Is that?
Yes, we do. We do have a portfolio of stocks which we are building. But more importantly, we are teaching the students how to fish. So we are teaching them simple methods of how to apply value investing to everyday life and to find stocks that are undervalued.
What of the principles of Buffett do you respect the most or affect you the most?
Right. For me, keeping it simple and sensible. In fact, that is, for me, is my foundation of all investing. And that's what I actually bring across to the students that we are actually training. And so far, they have been applying whatever that we have teach. And we always keep our methods simple. Yes. And from that on, actually the students is become, once they learn from us, right, actually it becomes very applicable for them to apply straight away into their portfolio, into their analysis. Yeah.
Are you guys owners of B shares or what?
Yeah.
Berkshire B shares?
We're owning a B shares.
We hold the B shares, yeah. Because the rest of the money is pumped into some more undervalued stocks at the moment.
That's right.
How's the economic health of Singapore? It's well run, right?
I would say Singapore has been doing very well for the past 5 to 10 years, but I would say it's slowing down now. It's a very developed country. Things have been slowing down a bit, so the whole economy is not looking that bright in the future. So in that sense, value investing becomes even more important, because only in a recession or where there is a depression, if you think it's coming, then we'll have more opportunities. So that's where we are all very excited. Yeah.
What do you guys think of Charlie Munger?
Oh wow, Charlie Munger. He's to me, he's a very really smart guy,
Yeah.
and in fact, I actually adore Charlie Munger more than Warren Buffett himself.
In some ways, he's more brilliant.
Yes, it is.
He
It
integrates more different pieces.
Exactly. And
Have you guys been here before? Or?
No, this is my first time.
So this is your first time?
This is my second time.
Second time.
Yeah.
Okay. How many folks are with you in this course that's going to be in Los Angeles? Are they all here too?
Half of them will be here, but the rest of them will be joining us directly in Los Angeles. We are offhand, I think, about 35 students.
And they're all from the Far East?
Yes.
All from the Far East, from Singapore, Vietnam, Thailand, Malaysia, Taiwan. Yep.
Wow.
So it's going to be a huge party with Mary.
How's Vietnam's economy?
Okay, Vietnam, I would say it's a very developing place. Lots of opportunities, but again, lots of obstacles too. So it's challenging. I would say challenging to say the least. But I think it's more interesting than if you say to pick good Vietnamese stock than to find good Singapore stocks, because I think there's much more gems to be uncovered over there.
Ivan, your other book is Profit from Your Mistakes, right?
Yes, that's right.
What are the biggest mistakes to avoid?
One of the biggest mistakes to avoid is, in fact, a lot of investors, they expect to win all the time. So to me, that is actually one of the key mistakes that investors have in mind. Every time they go into the stock market, they assume that they're going to win. And what they need to do is actually they need to have a lower expectation that sometimes they do make mistakes. Yeah, and by having a system, that makes a difference. They need a system to guide them along. Yes, because most of the time, investors without system, they are just like investing it blindly. Yeah.
Paul, you're the research director. How do you go about uncovering opportunities that fit this value investing criteria?
Well, usually we go from a bottom-up perspective, meaning we look at the companies itself, good fundamentals, good cash flows, low debt, and stuff like that. These are some of the criteria. But sometimes we also look from the other angle, from a macro perspective. Because, example, if the oil and gas industry has been depressed for a long time, so from there we try to look for some opportunity, because we believe that things are cyclical. And when things are down, it's the time where you look at them and buy them at very, very cheap prices. That's what Warren Buffett's doing. So we do combine both a little bit, but I would say most of the time we still come from a bottom-up approach.
Do most of your stocks come from abroad, or do you have American stocks too?
Well, personally, I have maybe 40% in Singapore and 60% in US.
Really?
Yes, so I'm pretty big on the US stocks, and I find that especially in terms of growth stocks, if you look at value growth stocks, there's much more value growth stocks you can find in the US compared to in Singapore.
All right. You got any big tips for us? Do you have any prediction as to what would be an emerging Berkshire, a baby Berkshire anywhere around?
Well, I was just at the value investing conference yesterday, and a CIO of Macau was speaking. So Macau was really something up and coming, and I would think they are like maybe Berkshire 20 years ago, and the growth rate is currently much higher than Berkshire. So
this has really been good for our show. You're the second folks that have hyped Markel. We have Tom Gaynor coming on later.
Nice.
So everybody's going to be prepped for what is this new Berkshire, because it doesn't have a huge profile.
No.
It's about 10% of the size of Berkshire, and it's just a huge runway.
Yes,
left
but the
over.
growth rate is incredible.
All right, let me ask you one question. You can each answer it. What's Berkshire going to look like in 20 years?
In 20 years, well, I don't have a crystal ball in front of me, but I would think that Buffett has already set up a good system, and I think the successor, whoever is coming up, would be able to apply the principle and do well, because end of the day, value investing has been around for many, many years. So I don't see a major change, and I think it's be business as usual.
Okay.
Yeah. In fact, to me, I feel that Berkshire Hathaway will still be around, and it's probably being set up very nicely, having a system that's being set up by Buffett. And now we have Top Comms and what's the other guy's name? I can't remember, but they are leading it quite well, I would say. Yeah.
Well, we had just before you one of the longest holders of Berkshire stock, got it around $100, and back then there were 12 people in the annual meetings, and now we have more folks from Malaysia and Singapore sitting in the next couch. than were in the whole original Berkshire meeting. Ivan Lowe, Paul Chen, thank you very much for your time. It's great to have you here. Please say hello to Mary Buffett for me.
Okay, we will. Thank you, Jim.
All right, we've got someone from my hometown now here in the lobby of the Hilton Omaha from Chicago. And you've got to be a long-term value investor if you're a Cubs fan, right?
Yeah, exactly. And I think we've been the longest-suffering value investors of all time. So this is the year, though, right?
All right, tell us a little bit about your background and how long you've been coming to the annual meeting here.
Okay, so my name's Rob Call. I run a small investment partnership called the IBEX Fund. And I've been coming to the Berkshire meeting for 10-plus years. I just recently finished my MBA at the University of Chicago, which people would probably shudder because that's the home of efficient market theory.
Yes,
so It's rare, but you actually do run into one or two U of Chicago grads here at Berkshire. We're kind of like the Alcoholics Anonymous, you know. You don't want to say you went to the school of the efficient market hypothesis around here, but...
All righty. I'm going to ask you to compare Warren Buffett with somebody that I hear you're becoming an emerging expert on, which is once known as Darth Vader of investing. That's John Malone. He was dubbed that by Al Gore. And to me, I'm interested to see what you come up with, because I look at him from afar and I see financial engineering, I see complexity, I see tax-driven strategies, all of which seems a lot different than Warren Buffett. Before you get into him, tell him how you see Buffett versus John Malone.
So I see that there's a lot of similarities to Buffett and Malone. I mean, obviously they have different ways of setting up their corporate structure, but I would say the first thing that's similar is in the character and the honesty of both of these men. They're very, very responsible. They're shareholders. Malone is known for having, when he was running TCI, very Spartan-like, bare-bones office. He once said that the opulence of the corporate office is inversely related to the success of the company. One of my favorite stories is when he took over a cable company. He made them move from their really opulent office into a used tire factory to run their operations. And
it's funny, Rob. I've developed this theory over time that as soon as a large corporation gets the excess cash flow to build themselves a monument, it's over. Yeah. Sears is a good example of that.
Yeah.
They built the Sears Tower. But anyway, go ahead, sorry.
Exactly. And I would say another a comparison is that you have the rare instance where there's a CEO who's actually a brilliant capital allocator. That's something that Buffett's mentioned time and time again, is that CEOs are usually people who are typically good at sales and come from other parts of the organization, and they've never had to deploy capital before. And Malone is obviously brilliant at capital deployment. If you had invested in TCI in 1973 and cashed out at 1998 when he stepped down, you would have $900 for every dollar you invested. And he's also someone like Buffett who he can make a very snap decision. Like one story you don't always hear is that one time, I think in the late 90s, a shareholder asked Buffett what discount rate he used for his DCF calculations, and Charlie Munger quickly snapped, "I've never seen Buffett do a DCF calculation in my life." And Buffett quickly responded, "Well, if you have to do one, the value's not good enough." So
great story.
Malone is known for making quick back of the envelope calculations.
His compound growth rate actually exceeds Buffett. Looking at the numbers you gave me, right? 28% or something?
Yeah, I mean, recently that's the new Liberty from 2006 till present day. That's 28%. And that's exceeded Buffett over that time. And I would say the entities look complex on the surface, but it's actually pretty simple once you get into it. I mean,
that's my next question. Go ahead, tell us how that is, because how do you get through it? It just looks so opaque, and it looks like he purposely tries to overly complexify this structure.
Yeah, and he does that for the reason, basically, I mean, his theory may conflict with Buffett's a little bit, but he does that basically to unlock value. So if you study the history of, Malone was obviously a pioneer in spin-offs and tracking stocks, and if you study spin-offs over time, they've vastly outperformed like the S&P 500 index, and mostly, the greatest value is unlocked in a spin-off usually in years 3 and 4. So recently, Liberty Media has actually split into 4 companies. There's the Liberty Broadband piece, and then just a couple weeks ago on April 15th, it's split into 3 different companies where Liberty Media is now. There's a separate tracking stock for the ownership of the Atlanta Braves, for their 61% ownership in Sirius XM Radio, and then one for their 34.4% stake in Live Nation Entertainment. So he does it to unlock value, and it seems complicated when you first look at it on a surface level, but once you get into it, it really isn't that hard to follow.
What's the purpose of the tracking stocks? Just that he's producing more value than if the Braves were lumped into somewhere else?
Yeah, to produce value and more clearly delineate that asset group and hopefully rise in value. It's selling at a discount to net asset value right now, and basically to single it out because before the Braves, I mean, there wasn't much detail on them in the financial statements because it was such a smaller piece. But now that you know that what you're getting an 80% ownership stake in the team. You also have of $500 million of mixed-use property that has an Omni Hotel, 600 upscale residences.
Are they a good investment, the Braves?
Yeah, you know what? If you've looked at sales of baseball teams recently, didn't the guy from the Dodgers just sell it for what $1 billion in cash?
They're asset-driven. They're not operating performance-driven, right?
And one thing about the Braves, if you have a really long-term time horizon like I do, is they inherited a really bad television rights deal when they bought it from Time Warner, so that expires in 2027. So they'll be able to renegotiate that for
a huge value
massive increase compared. I mean, they probably have one of the worst rights deals of all the major league teams out there right now. But they inherited that.
If Buffett tied tracking stocks to his components, right? I mean, he's got an insurance component, he's got the utility, he's got the Burlington Northern. Would that unlock value?
It depends on who you ask. I mean, I think if you ask Malone...
Where do you come down on that?
Yeah.
Malone would say yes.
I think Malone would say yes. I think Buffett would say no. I can see the argument from both sides. I've seen the Berkshire Hathaway method work. I've seen the John Malone Liberty Media method work.
So let them do their own thing.
I think both methods are very, very effective, as you can see. Both have long-term track records of unlocking.
Now, you said Malone is incredibly honest. You compared him to Buffett. What's interesting to me is that Buffett has that image publicly, but Malone doesn't have a good image publicly.
Yeah, that's interesting. And I don't know where that comes from. If it comes from people feel that he's abusing, loopholes in the tax code or what have you. But if you listen to him on the any of the shareholder days or any time you hear him interviewed in the annual reports, both him and Greg Maffei, who's now the CEO, they're very candid and honest and straightforward about where they feel the industry is going. There's a lot of challenges in the cable industry. They're very honest about threats to both, cable, XM radio.
I just interviewed last week Bob Wright, who you probably chairman of NBC, who was chairman. He built GE Capital, and he basically said John Malone is the guy that built the whole cable business. Basically, he was the strategic genius behind the whole thing. And here's a guy who's run an operating company for 21 years at NBC. So he doesn't get the credit he deserves, obviously.
I would highly recommend, if you haven't read it, the book Outsiders by William Thorndike. It has profiles of 8 outsider CEOs who followed methods very similar to Buffett. There's a great profile on Malone in there. There's one chapter on Malone. There's a chapter on Buffett. One of my favorite business books of all time.
All right, now we're going to finish up with, later on we have Tom Gaynor here from Markel. Everybody we've talked to keeps saying they're the next Buffett, they're the next baby Berkshire. You've actually worked there, so tell us what your thoughts.
Yeah, so I spent a couple of years working for Markel and Markel Ventures in an accounting capacity, so I got to spend some time with Tom and Mike Heaton and the folks over at Markel, and it was one of the greatest experiences of my career. I think the most impressive thing to me about Tom is his character and his integrity. He knows every single person's name that works there. It's amazing. He always remembers you, and the first thing that everyone always says when they talk about Tom is how well-behaved his children are. They always mention that, and that's always impressed me as someone who's able to, raise.
That's a leading indicator of a high-character guy.
Yeah, and so I think, they have done a great job of kind of following the Berkshire model. Markel Ventures is obviously expanding and becoming the operating businesses are becoming a bigger and bigger piece of the company. So it's not just solely an insurance company anymore, and I think that can only lead to bigger and better things.
And looks like a Berkshire-type path.
Yeah, it looks like definitely. I would say, with the exception of Fairfax up in Canada, it's probably one of the closest comparable companies.
Okay, so now we'll let you off the hook, but not before. When will the Cubs win a World Series?
I would say I'll go with either this year or next year.
Really?
They had they have a
the
big.
Ricketts have done a good job.
Yeah, they have a big injury, but Theo Epstein, who was the man
analytics,
the man that ended the Curse of the Bambino, he's kind of like the Wizard of Oz back there, and he's done some impressive things. So hopefully. the curse will be over soon and the Cubs will win the World Series.
All right, Rob, thanks for giving us a few minutes of your time, and I think it's fascinating that you sort of dissected and made more comprehensible John Malone.
Okay, thanks a lot.
Take care.